Welcome back to Gimme Some Truth. Today we are going to delve into the world of taxation. I have Ian and Alicia here, both from WC Tax Services. They are partners of that organization, as well as the main cogs there. We have some other people that are around it, but we don't really do anything. So they do all the work on the tax services side. And today, I guess I'll pose you both the question as an opener here. What percentage of tax returns that you run into have you seen problems with? When you take a look, is this a loaded question?
Yeah, I'd say that there's an easily identifiable error on maybe a quarter of the tax returns that I look at. I think more common is missed opportunities, not necessarily a mistake, but like, oh, you had lower income this year. You could have, realized some capital gains and paid no tax on it. So a lot of it is more missed opportunities, but there's still a good amount of just straight mistakes where people are overpaying. Straight
errors. What about you, Ian?
Yeah, I think it's an interesting question, and it's the tax code in the United States is so complicated, and I'm sure our viewers have had experiences with this, and you can post in the comments your worst experiences with filing your taxes. But I think the tax code is so complicated, it's almost, I won't say impossible not to make a mistake, but highly likely that people will make mistakes. And even professionals can make mistakes, because we're talking about thousands and thousands of individual rules that all have impact each other, and one thing goes wrong here, then now everything after that is wrong, and it's a very difficult situation. The way we file our taxes in the United States. So
I think mistakes is in quote too, because it's a mistake of, there can be a mistake that's an error, there can be a mistake that's an omission, there can be a mistake that's an interpretation. And
there's a spectrum, right? There's like the black and white, then that's actually pretty in the minority of issues, and then the rest is kind of interpretation.
Yeah. There's a lot of gray in our tax code. Yeah. That's right. So I think today we're going to get into some of the most common tax mistakes. We're going to go a little bit more on the personal side for a bit, and then we'll delve into the business side. So let's start out with a common tax mistake that you find, Alicia, on the personal side.
Well, I think the biggest one is when people file an extension. They think they are extending the time that they have to file their taxes and to pay their taxes. And you are filing an extension to file, but not an extension to pay. So if you are still going to have a tax bill, you have to pay that. And then people are like, well, how do I know how much to pay, if I'm not filing my taxes? And you have to figure out an estimate. So you make an estimated payment by the April 15th deadline, but then you have 6 extra months to then actually file the return and sort of see, well, how close was your estimate? But if you owe money, you still need to pay that by April 15th.
And Alicia, what are I'm not going to put you on the spot, but do you know the penalties for not filing versus not paying?
They are calculated based on how much you actually owe, so it's not like a flat rate. So the more you owe, the higher your penalty is going to be. But yes, there is an underpayment penalty that even if you file on time, but you don't pay enough, you'll pay a penalty for. And then in addition to that, there's the late payment penalty.
Yeah, I think if I remember correctly, the failure to file penalty is 10 times more than the failure to pay. So it's like 5% per month versus 0.5% per month.
Yeah, the longer it goes too, the worse it is.
It's an order of magnitude worse to not file. Yeah.
Well, yeah. So best practice is to file your taxes.
Yeah. Even if you don't make an estimated payment, just file, because you might pay some penalties and interest, but it's going to be significantly less than if you just don't file at all.
Yeah, that's right. Number 2, tax filing mistake.
Not claiming all of the deductions or credits that you might be eligible for. And a lot of people think, well, I just take the standard deduction, so I can't deduct all these things. Well, there's a lot of credits that you're eligible for, even if you don't itemize. Some are specific to your state return. So like Wisconsin has the 529. If you make a contribution, you get a deduction for state. But other things are what we call above the line deductions. So things like student loan interest or educator expenses if you're a teacher. Those things you don't have to itemize your taxes in order to claim those deductions. So just being aware of what those are. Another one that I think maybe might go into what Ian's talking about. If you're self-employed, some of the expenses that you pay, like for health insurance or some of the self-employment taxes that you paid, are actually deductions on your return.
Yeah, I find that one of those, the 529 is a great call out there because, if you're not getting that, like the 5498 comes out and shows you your IRA contributions, and that always comes in, like May. So you kind of don't get to see that until later. But there are other things where, you made those contributions and you just don't take advantage of that because you don't think about it. And sometimes a questionnaire, sometimes people skip through it. And I've noticed, or the EV credit is one of those too. You buy a car and then all of a sudden you forget to take the EV credit. You should have. So, those are items too that I think are real important. Number 3, personal tax return, common tax mistake.
So the third one is cost basis. A lot of people don't really understand what cost basis is, or they're not really sure how to figure it out. And it can get especially complicated if you inherit some assets, because a lot of assets get a step up in basis at death. Clint actually wrote a really good blog post on what assets get a step up in basis at death. But even sometimes the forms that you get don't accurately reflect what the basis is. A good example is here in town, we have Exact Sciences. And for people who get stock, they don't put the cost basis on the tax form. So I've seen people put in 0 because that's what the tax form says, but you actually have to go and figure out the cost basis for that. So a lot of people will end up overpaying because they aren't putting their correct cost basis on.
Yeah, let's just say that not having your basis is bad for you.
Yeah. You pay a lot more than you would otherwise have to.
And it's funny on that point, I had to deal with an issue yesterday where a 1099B from one of our clients didn't have cost basis, and it was related to a publicly traded partnership investment. And in those cases, you could very easily just enter 0, and then you end up way overpaying your tax.
Yep.
And you don't know that you have to wait for a separate K-1 from the partnership or some other reporting. So it's really, that's a great one to highlight.
You should definitely look through your tax forms and just make sure.
The small print. There's a lot of small print you need to look at.
Yeah, you got to look at those 1099s to make sure you don't miss one in there too. So every once in a while, you're like, if it's a real old position, because back in the day, they didn't require these companies to carry cost basis through. Now it's a lot better, but if you've held somebody for 30, 40 years or somebody gifted it to you, you might have a basis problem, and then if you end up with 0, like you said, way overpayment of taxes, it's bad. I'll share one bonus one that I find that, because we just had this scenario as well, so we'll go with a number 4 addition to the list is I did a backdoor Roth contribution, and then I did a conversion of it, but I also rolled in a 401k into that IRA, and now I've just screwed up everything that I just did. I've made my conversion amount become
trigger the pro rata rule.
Yes, trigger the pro rata rule.
The deadly pro rata rule.
That's right. So you just have to tread lightly when you're making those backdoor Roth contributions. Yeah. Also, I've seen somebody just make a backdoor Roth contribution and they had an IRA balance.
Report it correctly. Yeah. And it's taxable.
It's taxable. Yeah. And so, all those, I think backdoor Roths are fraught with a bunch of different, landmines that you could step on along the way.
And the thing is like so many people are like, well, I can do it myself. And it's like, you can, and a lot of people have, a simple enough situation that, they might get it right. But also, how much is your time worth? So even if you're able to do your taxes on your own, is that really how you want to spend your time? And then if you do end up getting tripped up on one of these common mistakes, you're going to be paying way more in taxes than you would be if you just paid a professional to do it, and then you'd avoid that mistake, and you'd save yourself some time and the stress of kind of going through and trying to do all of this yourself. So it's kind of a trade-off. It can feel expensive to pay somebody else to do your taxes, but ultimately they may save you more than you're paying them.
I'm going to take a wild leap of faith here and say that the people watching this podcast, people who are interested in financial news, commentary, people looking to get a financial advisor, your time is probably valuable and more valuable than, you wouldn't necessarily want to do your own taxes. I think that's probably a safe bet. Yeah.
Well, I think it's also safe to say that, just go ahead and get one of those IRS letters and see where your stress level is after that. If somebody else has it and you can go, okay, this is weird to get that. And I get them every once in a while because we have a pretty complex return, and I know that my CPA is going to take care of that.
Yeah.
And so, okay, I'm going to have her work on that. And oh man, if you
Peace
get
of
those
mind
letters,
is invaluable.
it's very
Yeah.
invaluable,
Yeah.
you know, especially when you're dealing with the IRS,
Yeah.
knowing that, my dad used to work for the Treasury Department, and so he used to work for the IRS.
Yeah.
And one thing he just said is like the IRS just doesn't mess around, and so
They're relentless.
yeah, so they always get their money in the end. So yeah, I've always been told you should not file your own taxes, but that's just me. So Ian, pivoting to you here, business tax returns. You're a little bit more on the business side as well as personal returns. So what's one of the ones that you've seen?
So a big one for businesses is estimated taxes and not paying estimated taxes, underpaying estimated taxes. So if you are a W-2 employee, you know, you have taxes withheld throughout the year, you're probably pretty good on your estimated taxes. As people may not know, like people are required in the United States to pay their taxes as they go. And if you like make one big lump sum payment at the end of the year for whatever reason, like they're going to penalize you and you'll pay penalties and interest. But with businesses, you know, your income is variable. Like you could have a ton of income one month and a loss the next month, or, you know, you're not withholding wages necessarily under certain business structures. So, you could get dinged with the big penalties and interest at the end of the year if you're in business for yourself, if you're in a small partnership or along those lines. So
yeah, it's actually due quarterly. So you have to figure out.
You have to settle up with the IRS quarterly.
Yep.
And that's not just for businesses, individuals too. Like but most people have W-2 wages where taxes are being withheld. But yeah, it's an issue. That's not just a business issue.
Yeah.
I'd like to look over the two contractors sitting over there in the room. They could probably do a better job.
I hope any 1099 contractors are making their
quarterly estimated payments, you guys.
I know one in the room that might be married to me is pretty bad about making estimated tax payments. I'll tell you that much.
No one loves to make estimated tax payments. I do it myself, and I'm always like, ah.
And don't forget about the state. You have to make quarterly estimated payments to the state as well.
Yeah. Okay. Thank you.
All right. Number two.
Number two is this is something that comes up in partnerships. So partnerships, say you and a friend decide to open a business together and you're informally, it's like, yeah, we'll just be partners. And then a lot of times what people do is they'll take their business activity from that partnership and then each partner will report like 50% of it on their Schedule C, which is like usually for sole proprietors. And that's a problem because a partnership needs to file its own separate return called the Form 1065. And so that's actually a fairly common mistake, is that these informal partnerships, new partnerships, smaller partnerships end up not filing the 1065, not generating the K1s, not sending those K1s to the individuals. So you can get dinged for that, and that's fairly common.
So ultimately, the income does end up on your personal return. You just have to go through an extra step before it gets there.
The 1065 is what's called an informational return. It doesn't pay taxes itself. The partnership doesn't pay taxes. It's a flow-through entity. So, but the IRS needs to see a 1065 for every partnership, whether it is a partnership operating with an operating agreement or not. You know, it's even if it's an informally formed partnership, it's still required. Yeah.
What's the best way, if you had kind of this informal partnership, to do it without all the hassle?
The best way, if you had a real partnership?
Yeah, if we were entering into a kind of a
you'd have to draft a simple operating agreement.
Okay.
And just make sure you're filing your partnership returns. You know, in that case, you almost always would get professional help. The 1065 is not a fun form to be figuring out on your own. The instructions for it are almost 100 pages, and you have to know about things like separately stated items, and yeah, it's fun. Alicia and I would like to do it for you. I don't recommend you doing it on your own.
That's how I got into taxes, is because I preferred to go and read the 100-page instructions and dig into every little detail of the tax code. And then I realized most people
Alicia,
don't
right?
choose to do that. Yeah. And then I was like, if this is how I want to spend my time, maybe I should be doing this professionally.
I think that's how I ended up as a financial advisor, not a tax
I mean, that too, yeah.
Follow your bliss.
Yeah.
Number three.
One final one.
Final one.
Yeah, so I've noticed some confusion around the the way that people start a business, say they open an LLC, and they'll say, oh yeah, I file my taxes as an LLC. And that's not technically correct because the phrase limited liability company does not appear in the Internal Revenue Code, right? The IRS doesn't know what an LLC is. It doesn't care. I'm being a little facetious because they obviously know what it is, but there's no tax treatment for a LLC. You have to elect to be taxed as a sole proprietor, a disregarded entity, a partnership, a corporation, or an S corporation. Right? So the IRS has a very limited number of entities that it recognizes and that for which there are tax laws. So I think people need to, and there's really big consequences for making one election or the other. So people need to be aware that their business, there's lots of different ways of forming businesses, and businesses are typically formed at the state level. You can form an LLC, an LLP, you can form a regular corporation. There's all these different types of corporations that are state level, but they all have to be kind of like funneled into this this framework that's set by the IRS. And there's big consequences for those decisions. And so definitely, if you have a business, talk to your advisor about what is the best way to structure this from a tax perspective, because it's a little bit like the tail wagging the dog sometimes. Like the tax decision, it seems like kind of an administrative, thing that's not that important, but it actually can, and many times, and I would say the most times, it ends up driving a business decision, and making mistakes in the types of entities that you form and how you elect to be taxed can make or break businesses in a lot of times.
So if the phrase is "don't let the tax tail wag the investment dog," then do we let the tax tail wag the business dog?
A lot of times people do. It's a weird situation, with making an election or not can completely determine what kinds of businesses you can open. It's a really complicated topic, and we're not going to have time to go into it.
It's a whole other podcast.
If people have any bad experiences of making the wrong types of elections, let us know in the comments. We like to hear about that. We'd love to hear from people who need help with their taxes. If we're always here to answer questions and.
Yeah, I'll say from personal experience, like, my wife and I formed a corporation together. We made an ill-fated investment in a restaurant. So, we'll just leave that at that.
I need to hear this story.
Even the investment advisors sometimes make really poor investment decisions. But, we formed a corporation, and I was back and forth with my accountant way more than I thought, because we were just going to form this entity. It was no big deal. It was called Man, Bear, Pig Industries, which I think is the best name. And it just, like, all of a sudden, it was way overly complex. And I was like, wait, I thought...
Before you even got to the business.
Yeah, I thought it was just a 50-50 partnership with my wife. Like, what's the big deal? And she asked me all these questions about it. I'm like, I don't know.
Yeah.
Like, I didn't think it was going to be nearly as complex as it was. And it kind of has set us back.
It sours the whole experience of the investment.
Totally.
Right? Investment should be about the economics and the fun, but a lot of people just don't even get out the gate because of those kinds of issues.
That's exactly right. Yeah. So the complexities, like, before you start a business, you really should do your due diligence and meet with the tax professional to figure out the right way to do it. You oftentimes have to get attorneys involved. So I think, like, the main takeaway is, hey, these are complex, and you need to involve professionals where applicable. And even on individual returns, there's plenty to dig through here, and there's plenty that you can miss, and that you can make errors by omission or errors. And, we've got to have professionals and a second set of eyes on things. So hopefully you found this valuable. Please comment in the section if you have any tax nightmares, questions that some of your...
I'm sure our viewers have some tax nightmares.
Yeah, exactly.
We want to hear about them.
Yeah. Exactly. So thanks for joining us on another episode of Gimme Some Truth.
Wachter Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Wachter Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.